I'll make a slow start, and again, welcome to you all. This is probably the 5th time we've had this annual private client convention in these surroundings. So thank you to this excellent St Martin's in the Field Church Amphitheatre. It's eventually going to be recorded. Irina, thank you for getting us started. ICA Consulting are taking care of the recording. For any sort of quick fire questions that you don't want to wait until the last Q&A session, just stick your hand up, and if it's easy, I'll answer them. If it's not so easy, Lawrence, my colleague, will answer. And it's really to introduce Lawrence, the Group Head of Tax of our global group, a barrister at law, worked for me in England for many years, and now resides with his family in Singapore and is attached to our trust and corporate subsidiary in Singapore, that's Sovereign Singapore. Some of you might know me. I'm Simon Denton, the founding managing director of Sovereign UK, just a few doors away up there in St Martin's Lane. And thank you for those that, thank you to all for attending tonight. There's quite a bit to get through, so on the sort of reference slides, ladies and gents, on the reference slides, we will be snappy and quick. There's 6 parts to get through. You've had the welcome. The new tax changes announced first of all perhaps by the Conservative then government and rode, cantered and galloped through by the current and maybe not so popular Labour government. Part 3, that's the excluded property offshore trust regime, still viable, but with a little much more narrower scope. UK and foreign family investment companies, insurance-based tax planning, the alternative to trusts for complementary to long-term residents, and private client mobility, the countries to which departing UK residents are moving to, whether it's this year or next tax year, and why. Questions and answers as we go. But I have to let you know some announcements to report that the Adam Smith Institute recently mentioned that by 2035, these domicile reforms that were introduced by Parliament, effective as April of this year, will make the economy 1.3 billion worse off per year from 2035. At the end of the year 2023, non-domiciliaries constitute 6.2 billion to the economy, obviously 6.2 billion to the economy, and now a lot less. And there are 16,000 millionaires that have moved out of the UK to date due to these reforms, and this is what we're going to address, and how we can actually undertake planning for the persons that are coming, the persons that are staying, and the persons that may want to, a bit like the French and Scandinavians, move away from the UK. Okay, so that's what we're going to cover in this evening, hopefully inside an hour, with some questions and answers to follow. So I introduce and ask Lawrence, my colleague, to take over to answer. Thank you, Lawrence.
Thank you very much, Simon. So just going to start off, and as I'm coming back in a minute, by looking at this QNR exception. So that stands for qualifying new resident, and that's essentially replaced the definition of non-domicile for income tax and capital gains tax purposes. So for income tax and capital gains tax, you've now got this new concept for qualifying new resident. For inheritance tax, you've now got this concept of long-term residence. So for inheritance tax, you look at whether you're not a long-term UK resident, and that's replaced being a non-dom for IHT. That's where you want to be, not being an LTR, as we're going to refer to it as. For income and capital gains tax purposes, the key concept is a QNR, which is a qualifying new resident. So it's LTR, QNR. These are the 2 new acronyms that we all need to start to get used to. I will go back and pronounce it in full because I think it all gets a bit confusing. So what's the definition of a QNR, a qualifying new resident? Well, it just looks back to the previous 10 tax years, looking at the tax year you're in at the moment, and you have to have been non-UK resident for all of the 10 previous tax years to qualify to be a QNR, qualifying new resident. So for the current tax year of the 25-26 tax year, you have to have been non-UK resident for all of the previous 10 UK tax years. That's the general rule. So that would mean that you would have to have been non-resident from 6th of April 2015 each tax year up until the current one. And if you come back for this tax year, you're a QNR. It doesn't matter if you've been non-resident for 20, 30 years, you'll still be a QNR. The minimum is 10 tax years. But there are these generous, well, you say generous, I think they are in some cases, transitional measures under which persons who have done at least 10 consecutive tax years immediately before the 6th of April 2022 can still qualify as QNRs. So the cut-off point is 6th of April 2022. If you came back to the UK as a UK resident on the 6th of April 2021, didn't matter if you'd done 30 years or 40 years before then, you would not be a QNR. But if you come back, if you've become UK resident again from 6th of April 2022 or 6th of April 2023, 6th of April 2024, and you were non-UK resident for 10 or more tax years before you came back, then you'll benefit from these transitional measures. But if it was, say, the 6th of April 2022 when you came back, you'll only have this tax year where you will benefit from the QNR exemption. So it's those clients really who want to be looking at planning urgently because they'll only have 1 year to do it. So what's the advantages? What's the benefit of being a QNR? Well, it means that foreign income, and we're going to come on to gains in a minute, but foreign income, which is the more complicated one, I think, is exempt from UK income tax, regardless of whether it's remitted to the UK. But as ever with these regimes that are introduced, where you're relying on an exemption from tax, it's never that straightforward, and there are complications in there. So whilst most types of foreign income are exempt, so you see there foreign, if I can read it, in foreign investment income, foreign pension income, income from a foreign pet trade, property, royalty, income from IP, overseas trusts, that's important, we're going to come on to that later. They're all exempt, but there are certain exceptions which don't benefit from the exemption. And that's the one very important one is gains from life insurance policies. They don't benefit from this exemption, and they didn't previously benefit from the remittance basis either. So that kind of mirrors the old position. Also, watch pension schemes and CUROPs, if any of you are familiar with that. Certain benefits from those pensions will not qualify for the income tax exemption. But basically, most types of overseas income is exempt, but a claim is needed and full disclosure on your tax return is also required. And I think just a quick word of warning on this, which I've certainly seen from clients overseas where I'm based. There's this tendency to think that if they are, say, a director of an overseas company, that because the company is registered in Singapore or Hong Kong, they can just move to the UK for 4 years, remain as a director, take out dividends, and then that's going to be exempt. Well, no, because it's going to then be managed and controlled from the UK by virtue of the director residing here. They would report that on their tax return, and you would find that that would be UK source income and wouldn't benefit from the exemption. So I think whilst on paper this all looks hunky-dory, in the detail you find it's actually a bit more complicated. And then just this minor point about the QNR will lose the income tax personal allowance. Well, you know, that's not the end of the world. And just one final point on it, sorry, before I pass back over to Simon, is this point about remittances of foreign income and gains that were taxed on the remittance basis. They will still be taxable if remitted, but there's this temporary repatriation facility which is available for the next 3 years. And we're going to come on to that briefly in a minute.
So this is really relevant to UK expatriates returning to the UK, perhaps after they lived here for 10 years, foreign nationals thinking of moving to the UK for skilled worker, global talent visa, and innovative visa, although we're seeing more people leave the UK than actually overseas persons coming to the UK. Capital gains tax exemption, we've got quite a few reference slides to get through, so we'll canter through these as quickly as can, Lawrence. And this is relevant to overseas gains that are really relevant to a Q&R, qualifying non-resident, being exempt from capital gains tax, provided that they make a claim. So the person or the old-fashioned non-UK Dom that was paying the 30, he or she paying the 30,000 or 60,000, they used to pay that tax, and they were quite happy with that regime. Now you've got to make a claim to enjoy this regime, and the claim has to be full of disclosure. The gain can be remitted to the UK, a bit like income, I suppose, in the non-dom regime of Greece and Italy. You can remit and you won't be subject to the charge, but you've got to make that claim. And Lawrence is going to talk about the temporary repatriation facility. So yesterday's non-UK Dom that was claiming that £30,000 annual tax charge or £60,000 tax charge, conditional to them being reasonably wealthy, income and capital gains rich, can remit gains after the 5th of April 25. They will be subject to a charge, but a reduced rate will apply if they can take advantage of the temporary repatriation facility. Just telling you that this deck that we're running through today will be sent to you all with a video recording next week, I hope. Temporary repatriation.
We could have a whole session on this, so we'll just be very quick. I think it's important just to bear in mind a couple of key points with this temporary repatriation facility. We'll refer to it as TRF. Again, it's another acronym. It's unfortunate that it's very similar to TRS, which is the Trust Registration Service. So TRS, well, you can take your own view on that. TRF is a good thing, and it's something that if you've got clients that can benefit from it, is definitely worth looking at. I think just a quick point on its relationship with the Q&R, because I think that's causing quite a lot of confusion. The qualifying new resident regime, that's available to any body who has been non-UK resident for the 10 years or more that I mentioned before, regardless of their domicile. And they can benefit from that regime for the first 4 tax years of UK residence. The TRF is only available to persons who were previously taxed on the remittance basis, but it could have been even before 2008. So they just have to have done 1 year or more of being taxed on remittance basis, even before 2008. There's no need for them to have been non-dom or non-deemed or not have been deemed dom on the 5th of April 2025. It's quite generous. You just need to have claimed the remittance basis for a previous tax year. The key concept, though, is you've got some of this qualifying overseas capital. That's basically income and gains that is held offshore that would be taxed if you remitted it. So income and gains taxed on remittance basis. But it does also extend to trusts. And that's where it gets really quite complicated. Again, not going to go into that in any detail, but I think just as a point of principle, where you can benefit from trusts is if you receive the benefit in one of the tax years to which the TRF applies, so that's 25, 26, 26, 27, 27, 28, and it's matched with income and gains that accrued before then in the trust, then you'll then benefit from this reduced rate. The reduced rates under the TRF are 12% for 25, 26, 12% for 26, 27, and then it goes up to 15% in the final tax year for which it is available, which is 27, 28. So I think that's pretty much all the points we want to say on TRF at this stage. We've got a lot to get through. And we're now going to move on to, and we will take questions as we go on, part 3, which is the definition of this LTR, which applies for inheritance tax, as I mentioned earlier. So this is effective from the 6th of April 2025. Domicile has been replaced as the connecting factor for determining liability to UKIHT by this concept of long-term UK residence, LTR. And with LTR, you've got to look back at the previous 20 tax years. It's not just like with a Q&R where you just look back at the previous 10. You've got to look back at the previous 20. So as we speak today, 6th of April 2025, you have to look all the way back to 2005 and work out whether you've clocked up 10 tax years or more in that 20-year period. If you have, then you'll be an LTR subject to certain exceptions. General rule is if you've done 10 or more of the previous 10 tax years, then you're going to be an LTR from the start of the 11th tax year. So if you go away at the start of this, so if you're not resident for the 11th tax year, then you should be okay. But that's the general rule. As I say, it is subject to certain exceptions. One of the key exceptions is that for non-doms who left before they became deemed domiciled, so they left in the 2025-26 tax year before they became deemed dom, they're okay. So they will not be Q&Rs. For those who were deemed dom when they left, but still non-dom under general law, they only have this 3-year period to get through. So after they've been non-resident for 3 tax years, they will not be an LTR. And I think it's just also worth bearing in mind with losing LTR status, although the general rule is that once you've been UK resident for 10 tax years, you are an LTR the next year. If you've only been UK resident for up to 13 tax years, then once you become non-resident again, you can lose your LTR status after 3 tax years, and then it goes up by 1 tax year for each year thereafter. It's only once you've been UK resident for 20 tax years that you've then actually got to be non-resident for 10 subsequent tax years to lose the LTR status. So it's a little bit more complicated than saying that you have this 10-year tail as soon as you've been UK resident for 10 tax years. That essentially is all we want to say on LTR. And now it's back over to Simon, who's going to take us through in part 4 the status of excluded property trusts under this new regime.
Thanks, Lawrence. We're coming now on to some illustrations and case studies. And ironically, despite the challenges of these reforms, what we've done here is summarise the still positive treatment of setting up a trust. They're still viable. They can still be used. And as an illustration in a minute, that will move you through the importance of offshore trusts, especially excluded property trusts. And setting up an excluded property trust, an offshore trust, perhaps using a well-known trust company that has overseas trust companies regulated and licensed, no guesses who that could be. It's now, the status is determined by the settlor not being a long-term resident, not being in the UK for 10 years or residing in the UK for 10 years. Ideally, they will be on their way to the UK, or maybe not at all coming to the UK now due to these reforms. So an LTR less than 10 years resident of the UK. The domicile landscape has been completely trashed, ruined and replaced by the residency-based continental landscape, if I may say so. Effective from the 6th of April 25, a few months ago, the trust needs to be settled with overseas assets, a non-LTR, and the EPT status, the excluded property trust status, will be lost once the settlor becomes resident of the UK for 10 or more years. The trust then will be subject to exit charges if the settlor becomes an LTR, those exit charges are similar to the 10-year or anniversary charges, especially when the settlor becomes or gets to a situation of 10 years or more.
And it's just worth noting that when they can settle these, they can actually settle it in the 10th year.
Yeah, exactly.
So only after the expiration of the 10th year that the full starts the 11th year where you're in LTR.
For the advisors in the room, the only benefit to this legislation that I've managed to trace and materialise is that you've got British expatriates overseas that have been overseas for 10 or more years, and there's 5 million British nationals, so I'm reliably informed, living in many different countries. There's one here, lives in Singapore, and not going back yet because of maybe these challenges.
It's a British person, British-born person, a person that perhaps had a domicile of UK origin under the old-fashioned landscape, that has been non-resident for 10 years or more, not about to come back just yet perhaps. They can settle a trust. They can be a beneficiary of the trust. They can settle in overseas assets and take benefit and use an excluded property trust, very much like a Belgian person living in another part of the country, or a Belgian person that comes to this country and become a long-term resident. So British trusts applying now to British nationals that are expatriated is a good bit of news, and we're now finding that we're setting up trusts for those expatriates that, having taken a look at this legislation, they decided, well, I'm not coming back to the UK just yet. But if they do come back, they can qualify as a qualifying new residents and take advantage of that 4-year rule as well. Last point, on a non-UK resident settlor, whether it's a British person 10 years or more, or a classic non-British person, income and gains arising not subject to tax at the trust level. A qualifying new resident that sets up a trust pre or during the 4 years will not have any income and gains taxation, but from the 5th year they will be. And after 10 years of being UK resident, the settlor will, unfortunately, or the trust will lose its excluded property trust status. Income and gains made within the trust will be exposed to income tax and capital gains tax. And to avoid that, those trust assets being exposed to UK inheritance tax just before the 10th year, not needing it to the last minute, the settlor or the settlors, both spouses, would have to become excluded as a beneficiary to avoid the trust assets being exposed to inheritance tax, although the 10-year charge will still apply.
Just to be clear on that point, the exclusion for inheritance tax purposes, it's just of the settler, and it needs to be done before the 10th tax year before the end of the 10th tax year of UK residents. If you do it after that, you'll have to survive, the settler will have to survive for 7 years for it to be effective. So you definitely want to do it before the end of the 10th tax year. But for income and capital gains tax purposes, unfortunately, you've only got a 4-year period of being a qualifying new resident for new trusts that we're setting up post 6th of April 2025. So you get 4 years, assuming you're a QNR, get 4 years exempt, but then you'll need to look at a different planning within your trust structure after a 4-year period. And what you're going to be looking at there is either the exclusion of both settler and spouse, or possibly life insurance or collective fund arrangements at the start of the 5th tax year. And we're going to be coming on to that planning in this talk.
So starting with the slightly more easier of the illustrations and case studies, this is an excluded property trust, a trust established pursuant to the laws of Isle of Man or Guernsey, but it could be any regulated, respectful overseas jurisdiction where the trustee is regulated. The settlor is non-resident. They decide to appoint a trustee, let's call them sovereign, and the initial property is £100. The trustees are invited to appoint the settlor, spouse, children, other loved ones, or more complicated family members by marriage or otherwise as beneficiaries. The trustees are advised or requested to set up an overseas company, just a non-UK company that is not managed and controlled in the UK.
additional assets are settled into the trust, non-UK situated assets. The trust will have a regular common bank account overseas in Isle of Man, Guernsey, Cyprus, Malta if you want something in the EU. Contribution into trust, no tax charge going in. Everyone can stay as beneficiaries, might even have UK resident beneficiaries, so long as they weren't a long-term resident settlor. The investments or the contribution of cash is loaned into the special purpose vehicle, the offshore company, and that starts as cash, moves into investments and other assets sold and reinvested. Careful on UK shares and UK assets and property-rich situations, and this arrangement will be modified and tailored to suit each client. The underlying company may not need to be used, but should be used for qualifying UK investment purposes. Typical examples being shares in UK companies and UK sites loans. So double structure, old-fashioned, conventional, excluded property trust planning. The settlor may become resident in the fullness of time. They may not, of course, depending on the legislation. And this is very effective for asset protection, wealth protection. Not an expensive arrangement because we're not investment advisors or stockbrokers, and that's a conflict of interest anyway. So regular charges for a trusted company providing all of that asset, wealth, inheritance tax planning for that non-resident who's not so certain where they're going to be as they get a bit older. Case study, Lawrence. And any questions, please put up your hand.
So far, no. So this is designed to show what can now be done, this case study of Carol and Mike, what can now be done by persons who are still UK domiciled but have been non-UK resident for more than 10 of the last 20 tax years, so therefore are not LTRs, long-term UK residents. So Carol and Mike have been non-UK resident continuously since 2012 and were still and are still UK domicile. I think it's important to remember that domicile hasn't been abolished as a concept, it's just no longer used for tax purposes in most cases. It's still relevant in a few, one or two bits of tax, but it's generally now not going to be used. Still important in other areas of law, such as succession law, but not for tax really anymore. They previously resided in Hong Kong and are now resident in Malaysia. Their two children are at boarding school in the UK, and they will shortly start university in the UK. The children have been UK resident for more than 5 tax years. Carol and Mike plan to retire in Thailand and visit the UK regularly to visit their children. Carol and Mike have been advised that once both children are at least 18, the parents can spend 120 days in the UK and not be UK tax resident. That's just a quirk of the statutory residence test. Once children become 18, they're no longer a family tie. So clients, very, very common situation where in this type of scenario where you can still have a UK property and do 120 days a year in the UK without becoming UK resident. And this is really where you want to be. You don't need to rely on QNR or anything. It's just, well, I'm not resident, so I'm only taxed on UK income and gains, certain types of gains, and that's it. So the parents want to put in place some succession planning by jointly settling 8 million of non-UK liquid investments into trusts, and they're going to be the joint settlers of this. So yeah, I can just see this illustration here. Mike and Carol, joint settlers, an overseas trust, probably Isle of Man we would use. And Mike and Carol can be the beneficiaries along with their children. In terms of just to rattle through the tax treatment of this, and remember this is 8 million that they're settling in. If they settled this before the 6th of April 2025, there would have been a 20% tax charge, essentially, on over and above 650,000. So you're talking most of that settlement would have been taxed at 20%, but because they're doing it after the 6th of April 2025, there's no lifetime inheritance tax. So these are really the type of clients that are big beneficiaries of this new law. Income and gains accruing to the trust will not be taxed in the UK. No 10-year charge because it's excluded property, no inheritance tax. UK residents taxed on a benefit received basis. And you might want to pause for thought here to say, well, what's the advantage in using a trust, given that if Mike and Carol just leave the assets to their children in their will, there won't be any inheritance tax anymore? Well, I think there's two key advantages here for using this sort of planning. The first is that if you make any lifetime gifts to the children, or indeed a gift on their death, then the children are going to be subject to income tax and capital gains tax on the growth because they're UK resident. Whereas when it's wrapped in a trust, you don't get that tax. Secondly, if you leave it to the children directly, then they're going to be QNRs soon. They've been UK resident for 5 years, they're likely going to remain UK resident. So it forms part of their chargeable estate for inheritance tax. So you're moving it out of an inheritance tax exempt zone when it's Carol and mine to an inheritance tax chargeable zone when you're leaving it to your kids. So by putting it into an overseas trust instead, there's never any chance that the overseas trust is going to become an LTR, because the trust never going to become UK resident. So you're locking it in to an overseas trust situation, and you're locking it outside of the IHT net in this situation. So it does seem to me to be quite attractive for these clients who could not use trusts before. They could use trusts before they had 20% charge if they wanted to, that was a deterrent in most cases, are now free to use them. And I think they're probably the two key advantages that are hopefully illustrated by this example. There's just one final point to note, that in this sort of case, we didn't use a company. The reason being, an underlying company, was that there was no risk of holding any UK situs investments with this sort of thing. They were just going to invest in overseas assets that were fine. When there's any risk of having a UK situs investment, such as a loan to a UK resident or something like that, or any shares in UK companies, you want to have that underlying company to ensure that it's an EPT. So unless we've got any questions on that so far, it's back over to Simon and the next example.
Okay, thank you, Lawrence. And almost keep it to time, but do raise any questions. This is a little more sophisticated in terms of the planning and the bespoke nature. It's for an overseas trust, excluded property trust, applicable to UK residents. Now, the settlor in this case, lady, man, or lady spouse, male spouse, joint spouses, are not yet a long-term resident, haven't lived in the UK for more than 10 years. Ideally, they should settle it before they come to the UK, and ideally during the time they are a qualifying non-resident. Again, they are appointing overseas trustees, licensed, regulated, must get a trustee that has the relevant indemnity insurance and experience, hopefully neutral of any overseas or UK bank and financial house. The settlor has asked the trustee to be appointed, minimum contribution, and in this case, because the settlor hasn't yet reached a long-term resident position, he or she is the beneficiaries along with children and other loved ones. Careful on foreign real estate, certainly UK property-rich assets, but that's case by case. Contribution of wealth goes into the trust by the settlors, non-UK wealth into the trust, and then the trustees are invited and requested to set up the overseas company, onshore, midshore or offshore, but not a UK company and not controlled and managed. Assets settled can be retained, sold, reinvested, and it's a loan of assets from the trust into the company. Now, the tax treatment on this has got to be a little more carefully scrutinised. This provides an immediate shelter for inheritance tax, so God forbid there is a demise of the settlor prior to the 10th year of UK residence, supposing that they're not going to leave the UK, no inheritance tax. During the time that the settlor or settlors, female, male, heads of family, are qualifying non-UK qualifying new residents, During the first 4 years, the income and gains really are relieved from taxation. After the 4 years, income and gains become on point. There's no real hiding place. The income can be deferred from taxation if the settlor and the spouse is removed as a beneficiary, excluded as a beneficiary, leaving the children and other loved ones of any type as beneficiaries. If the settlor and spouse stays on as beneficiaries, because it's a little more difficult to generate income these days than 20 years ago, and all you're worried about is protecting the asset from erosion, attack, and various other reasons, they can just have the liability of income and gains taxation. Just before the 10th year, to ensure that the trust assets and the arrangement is not exposed to inheritance tax, God forbid, the settlor or settlors die on the 10th year and one day, can happen, dreadful stories around and that sort of thing, the settlor should be excluded as a beneficiaries, therefore gives of reservation and benefits and all those anti-avoidance measures will not apply. And if the settlor is excluded, conditional to them being a UK resident for 10 or more years, becoming a long-term resident, then you've got inheritance tax benefits, reliefs, and the advantages that a traditional excluded property trust will enjoy. Separate structures for UK real estate, property-rich companies, very much case by case. A lot of tax advisors in the room, lawyers, accountants, chartered tax advisors. So for a UK person, we would have to get a little bit of conditional tax advice, but we know what to look for, we know what should be written, and that's how an excluded property trust should look like, behave, administer, still not expensive, good benefits to be enjoyed. The kids can't crash the company or the trust. It's all within the asset protected arrangement, because children sometimes think it's easier to spend money than save it, isn't it? So you've got that generation planning ability. Richard. There's a few Richards in the room, but case study Richard.
Yeah, so Richard has resided in the UAE for the past 15 years. So again, he's comes within the definition of not being an LTR, but he is a QNR, which is where you want to be. So he'll be returning to the UK with his wife and their 3 children, and the children will complete their education in the UK. The family will return to the UK in August 2025, so they'll all be UK tax resident from the 6th of April 2025. Let's assume none of them qualify for split year. Richard has been UK domiciled and he plans to remain in the UK for more than a decade. Richard's main assets are a Dubai company worth 4 million held in his own name and an investment portfolio of 3 million. Richard is advised that as a QNR, he'll be able to access the new regime, which ensures that his most types, we're discussing overseas income and overseas gains, will be exempt from UK tax until the 5th of April 2029, provided he makes the appropriate claims. He plans to sell the Dubai property within 2 years of his UK tax residence, and he will settle the proceeds of the sale into an EPT from which Richard and his spouse will be excluded as beneficiaries before the 6th of April 2029, and his 3 children will be long-term beneficiaries. No need for them to be removed. The EPT will initially invest through an underlying company in overseas funds. Richard is advised that the gains from such a portfolio should not be taxed on him or any beneficiary until they receive a benefit. So it should be possible for the overseas company to invest in UK property, and I'll explain this in a minute in the diagram, which will be subject to corporation tax. So let's just have a look at how this works. So for the first, Richard isn't going to be excluded until just before he loses his QNR status. So for the first 4 years, he's able to benefit from this structure and then he and his spouse will be excluded as beneficiaries. So that means that when he loses that status, you can see there from the 5th of April 2029, he's got to be excluded, as has his wife by then. And from that point onwards, you've got to ensure that the only profit that's generated within this structure is income, unless it's within the UK company. Because at the UK company level, it can be income and gains. And that's why you can have UK property within this structure. So I'm saying it's a UK company, it's obviously an Isle of Man company, but it's actually subject, Isle of Man companies are now subject to corporation tax on any UK property portfolio that they hold. So any gains are subject to corporation tax. So what all this means is that that Isle of Man company is holding offshore funds, which are non-reporting funds for UK tax purposes. And in this example, it's also holding UK property. So you might say, well, why do we need to hold offshore funds here? Well, the reason is that if this structure generates any capital gains, then they will be attributed to the settler under this anti-avoidance rule. We have Section 86, which now applies, which is wider than the income tax anti-avoidance. But by ensuring that all we have at the Isle of Man company level is income, then that won't apply, and the exclusion of the settler and spouse ensures that we continue to get tax deferral. So it's very important that the investment is held within offshore funds, or in this example, UK property as well. And because the settler is excluded from benefiting along with their spouse, that works for income tax deferral purposes. It also works for inheritance tax purposes as well. So there won't be any inheritance tax charge on Richard's death. Where it gets a bit problematic is for 10-year charge purposes. Once Richard becomes and for inheritance tax purposes, once he becomes a long-term UK resident, so after 10 tax years, the trust becomes a relevant property trust. But you can see here that Richard is planning on becoming UK resident for around 10 tax years. And I think the interesting thing is with this type of trust, which I'm sort of advising clients on at the moment, is if you hit your first 10-year anniversary because the settler has been UK resident for 10 tax years, you want to try and get out as quickly as possible. So if you can get out by, say, tax year 13, then there's only another 3 years you have to do to revert it back to not being an LTR. So you'll find by the second 10-year anniversary, it'll flip back to being an EPT. And there are small exit charge considerations here, but the point is, with this sort of planning now for 10-year charge purposes, it follows the status of the settler. So if the settler is not an LTR on the 10-year anniversary, there is no 10-year charge. If the settler is an LTR on the 10-year anniversary, there is the 10-year charge. So you've got to just try and mitigate those charges. But it's not the end of the world. The 10-year charge is only 6% maximum.
So is there any benefit to setting them up in different days and set them in different days?
Yeah, I mean, you could potentially look at that planning as well for mitigation purposes for 10-year charge. But I mean, all of this is obviously still being worked through. And I think the other thing on that is timing-wise when you set it up, because if you think about it, you get the 4 years where you're completely exempt from income tax and capital gains tax on overseas assets. So it may be that you wait until kind of almost the end of the 4th year before doing your EPT and this sort of thing. And then it kind of gives you then a longer time to potentially not fall within that problem. Because potentially when the 10-year anniversary occurs, you won't be an LTR. But obviously, all of these things are still being worked through. But I think the basic point to take from this case study is that as long as you can ensure that at the Isle of Man company level, all of the profit is income or subject to corporation tax, then there's no attribution to the settler, provided both him and the spouse are excluded as beneficiaries. So now, if it's over to Simon, we're going to move on from EPTs over to Simon, the investment companies.
And the investment companies, a few in the room are here to listen to this.
Yeah.
So on the LTR, a lot of clients may be able to leave the UK. There's a lot of countries to go to. There's 17 I'm going to touch on in a few minutes' time. Obviously, don't die. Life insurance can always be secured for the period. Life insurance can always be secured for the period of uncertainty, and that need not be expensive as long as you're 55, 65 and not 95. So there are options available. So UK and foreign family investment companies, no apologies for saying foreign because they don't have to be registered in a tax haven. They can be registered in an EU member state like Cyprus or Malta, or a mid-shore country like mid-shore domicile like Singapore, covering UK and foreign family investments companies, structures of applicability, tax treatment of case studies. Highly relevant for your old-fashioned UK DOMs that are still exposed to UK inheritance tax, therefore long-term residents, those that are not expatriating, long-term residents, that's persons that may be of a foreign nationality, lived here for more than 10 years, or just persons that are just allergic to trusts, allergic to giving assets to a trustee. And there's quite a few of those. There's some aggressive bank trust companies, and aggressive financial services companies that own trusts that wish to sell their investment products. We're a bit different, or quite a bit different. So UK and family investment companies. You're giving the spouses, heads of family, sorry for being a bit Edwardian about it, but heads of family, the right to control. You can't have really day-to-day control over a trustee. Therefore, the trust would perhaps be a sham. You're giving the chance of the heads of family enjoying a classification of shareholding, usually a voting share. At the outset, the founders, let's call them founders as opposed to heads of family, are the shareholders of all share classes, and then they decide it's relevant with advice taken to gift certain share classes to other loved ones. There may be a share class allocated to a spouse, not because we're being sexist here. One of the spouses may be high income earners and they don't want her or his classification of share to increase in value, thus increasing inheritance tax liabilities. There would be a separate share class given to children, and the children may be of infant age, a very young age, and still not having the experience of their parents in running, managing investments and trading companies. They could be given shares that have no voting rights, discretionary dividend rights to perhaps give them a cost of living when it's relevant, and they'll have the growth rights. So the future growth will be allocated to those good people, or those youngsters, because they'll be enjoying future growth, and because the children are expected, God willing, to out-survive their parents by 30 or 40 years, in my case it may be a bit more, those that know me a little well, then the valuable shares are therefore held for the benefit of a much younger generation. Control and management for a UK company can still rest with the founders of the company. So I'm going to canter you through a illustration. A non-UK resident founder, a bit allergic to setting up a trust, understands the benefits of an Isle of Man, Guernsey company, no tax in those jurisdictions, but might also consider a Cyprus company in view of EU treaty freedoms, and especially if that passive investment company is going to own trademark, patents and IP, image rights, sports rights. Providing there's a bit of development in Cyprus, Cyprus companies or companies incorporated in Cyprus can enjoy an 80% tax credit in view of IP income. So the effective rate of tax in an EU company is 2.5%. Anyway, donor contributes capital and loans into the family investment company. in exchange for owning all of the share classes. The founder carries on with his own or her own share class. He or she gifts all B shares to all share class children, all share classes to children, and loans are okay. So the end result is that the donor has rights to vote, potential rights to dividends. He or she has gifted B shares, which has capital and income rights, maybe not voting rights because they're of a young age, but they're going to outlive their parent by 30 or, in my case, more years, hopefully. The donor survives 7 years because it's a potential exempt transfer, and A shares of the founder is retained, but the value of those shares are perhaps under the nil rate band for inheritance tax, so less or no inheritance tax on the founder, and you're giving the valuable growth and other shares to a younger generation. Drafting of articles is key. Watch out for gifts, reservation of benefit charges, and that's one way of introducing a family investment company that has certain rights and benefits that of a trust, not the same as a trust, it's an alternative to a trust, and with various classifications of shares and control, it becomes quite a compelling arrangement.
And I think this is quite useful for clients who are not going to become non-resident for more than 10 tax years. I've got a case at the moment where they're looking at this type of structure, where they're going to, because it's quite common for clients to become non-resident for 6 tax years for income tax and capital gains tax purposes, but then they don't want to do the full 10 years for some reason of non-residence, and then they could obviously do the EPT planning after in the 11th tax year of non-residence. So this is going to be for more your clients who are leaving the UK, but they won't clock up the full 10 tax years. And then you'd say, well, why would you use Isle of Man or these kind of overseas jurisdictions rather than a UK company? Well, I think it's pretty obvious that if you're non-resident, then you don't really want to be paying corporation tax on the income gains. So you want to be structuring it like this whilst you're non-resident, and then potentially you're then going to be looking at moving it onshore, so just swapping the directorships to UK directorships when you actually become UK resident again. But that's kind of the applicability. So if we just switch on to the next slide, which shows you
UK
how,
family
so this is a UK family investment company. It just shows you the different types of shares that you can hold within both UK and an overseas FIC. So you need to, all of these share classes are both applicable for UK and non-UK. Typically, if you've got a UK resident who has an FIC, you're going to want to be quite careful about making it too complicated. So normally, if it's a UK FIC, which is going to be someone who is a UK resident and not a qualifying new resident, typically, you're just going to want to limit it to A shares which carry voting rights, which the founder's going to retain, and non-voting shares. So you're just going to want to limit it to those 2 classes, and you're probably not going to want to have any loans in from that person either. But if the founder is a QNR, then that's when you can get into these more kind of sophisticated share rights, and that's probably where you'd want to be using an overseas company for it. But this is just to really show you the different classes of shares that you can have. So just to rattle through that, the A shares generally are the rights to retain vote, is the voting rights. You can also look at having a B share, which is sometimes a golden share, where you're going to use a trust to hold that. You then have dividend rights, which here we're saying C shares, and you've got capital rights, which we're referring to as D shares. But the general principle with an FIC is that you're just dissipating the value of the underlying assets with these different share classes, and ultimately the founder is making a gift of the value shares to his family members, which, as Simon has mentioned, is a pet. And you survive for 7 years, and the end result is the value of the shares, which are typically voting, are not high value. But I think with this FIC planning, what you're going to see is for the new QNRs, potentially is to have it offshore for 4 years and then bring it onshore before the start of the 5th tax year and basically move it from an offshore into a UK company. And you might want to start it off its life with these more sophisticated share classes, narrow it down before it becomes a UK company, which you're going to want to need when you're not a QNR.
And this was a particular example that I worked on with some tax advisors because the younger generation shares was going to increase in value. They were taking less distributions and they had the value and growth rights, and the founders, the older members of family, mum, dad, grandparents, were taking out distributions, dividends, reasonable directorship fees, so their share class was going down. So for inheritance tax purposes, it's working quite well.
Yeah.
So maybe we switched around on that, but it doesn't matter. And now we're working on to the last serious part, and there's some Swiss insurance specialists in the room. So welcome to Caroline from Switzerland, good friend of mine. So welcome. And she's and is rather tuned into insurance-based tax planning with a focus on non-personalised portfolio bonds.
Yeah.
It does actually trump, excuse the pun, the draconian legislation that's been introduced in the system.
Yeah, and I think with these, the way of looking at it is that you continue to benefit from tax deferral with life insurance planning without having to rely on that exclusion planning of the settler and spouse. So potentially you've still got to rely on the exclusion of the settler for IHT planning purposes before the 10th year. But what this case study is designed to illustrate is that you can continue to benefit from income tax and capital gains tax deferral with the use of life insurance, provided the settler leaves before the 10th tax year. So Linda is 58, non-UK resident for the past 20 years. And she has a son who resides in Australia, daughter who resides in Indonesia. Linda's daughter has 2 children, both under 5. Linda has been previously advised that she's still UK domicile, very common. Linda's parents are elderly, and as their only child, she's going to return to the UK to help them out in their later years. Their life expectancy is 5 to 10 tax years. So Linda plans to return to Bali, where she'll retire with her husband after her parents' passing, and then it's likely that her daughter at that stage is going to going to move to the UK for uni. So Linda holds 3 million in liquid investments and 2 million in cash. She's advised to set up a trust structure, as she'll be a non-long-term UK resident for inheritance tax, so she can pop these assets into trust without any 20% charge issue. So she decides to set up an excluded property trust structure. Linda is advised that the assets should be held through a life insurance bond in this specific case, which is not a personal portfolio bond. She can be a beneficiary, as can the children and grandchildren, future grandchildren, which would just be defined as a general class. So you can see there that Linda settled 3 million in. It's invested by the trustee as policyholder, non-personal portfolio bond, and that just means that it's held in standard collective investments such as overseas listed funds and unit trusts and those sort of things. The premium goes down by the trust, pays the premium by the trustee, and then you've got this 5% facility which can be used each year. What happens is the trustee can withdraw 150,000 each year from this structure, which Linda's still a beneficiary of, and she's still getting the benefit of tax deferral on income and gains that grow within the policy. So the trustee pull out 5%. The trustee pulls out 5% each year, and that gets advanced to Linda as a capital distribution. That should not be taxable, because it's a dry structure, there's no income and gains with which that benefit can be matched. And that continues. And then ultimately, Linda becomes non-UK resident before the 10th tax year of UK residence. So she's not an LTR. She leaves. She's had kind of a cake and eaten it. The trust remains an EPT at all times. So it's outside of IHT. On Linda's death, no issue at all. And there's no 10-year charge. And then what's more, when the children become UK resident, they can continue to benefit from this 5% facility that's provided by the life insurance bond. And when you don't use these 5%, you can carry them forward to future tax years as well, which is going to be useful if the children don't become UK residents straight after Linda's death. So this is quite a useful solution for clients in this type of situation. So on that note, we're now on to the final
couple of minutes.
Yeah.
And once we finish on time, and there'll be drinks served shortly. So well dessert, I think. Afterwards, so we'll stay. Morris and I will stay around for, as is David Griffiths, my colleague, fellow board member of Sovereign UK. Roberta as well. Thank you for Roberta for stage managing this seminar and its organisation. So we're going to be around, and please take a drink outside with us, and maybe we'll move outside later for pizzas and wine in the fresh air. So this is quite relevant to when this sort of grid was created by myself, because it was clear that a lot of UK people UK taxpayers were thinking of moving overseas. They started to sort of contemplate the reality of overseas when they were stuck, marooned in another country, no thanks to COVID, and not able to travel, and many found that they could do hybrid working, remote working, perhaps needing reduced office space. So COVID was a trigger to a little bit of extra client mobility. But the countries to which departing UK residents should consider moving to, and why they are really moving to. And I start with the first 7 countries being member nations of the EU. Back in the day, where non-dom tax planning was very, very easy and straightforward, there was no EU tax competition. Anything talked about that was deemed dreadful. They also thought Brussels were even thinking about harmonising tax throughout the nations, and I think the UK put a stop to that, saying tax competition is a good thing, which they were dead right when we did have tax competition. So the first 5 countries out of 7, ironically, have classic non-dom regimes. Even Italy and Greece have recently enacted non-dom landscape regimes, because they actually find that foreign investors or foreign people invest in their countries. The locals welcome it. The local government, provincial and federal, welcome it. And so you find that Cyprus, Greece, Italy, Malta, Cyprus and Malta being modelled on English law, and they're modelled on English law, and English common law exists. But you have Ireland as well, also having a classic non-dom system. They're not about to break that, because they know how much foreign income is really coming in, and how many people are really moving to the shores of these non-dom landscapes. So taking this grid, and you'll get the deck next week, you've got the nation down the left side, you've got the tax regime, non-dom, first 7, they're all onshore EU, so no need to pedal over to the Caribbean or some far-flung destination to enjoy tax planning. Got a little bit about the residency situation, the tax implications and the requirements. In the non-dom regime in Italy, it's got a bit expensive. It's £200,000 a year, regardless of the level of income that is being generated, as long as it's not locally sourced. Greece is a little more friendlier, 100,000, but they've got, Italy and Greece have the pensioners regime, 55 and onwards, providing you're drawing a pension. Malta and Cyprus, lower profile countries, but they have wonderful regimes available for entrepreneurs, pre-retirees, young retirees, part-time retirees, and upwards, and other age groups. So those are the non-dom regimes. Moving over to Ireland, another non-dom regime, and we feature Portugal and Spain there. Portugal, unfortunately, has lost its classic non-habitual residency regime, but they do have attractive visas. They have a golden visa policy as well. But Portugal, unfortunately, lost the regime because the foreign persons were pushing the prices up so much. The regime was overheating. They decided to, the socialist government decided to reform it. Spain is slightly attractive, not as good as Greece, Cyprus, Malta, Ireland, and Italy. They have the Beckham law, which is a qualifying regime, useful for 5 years. 5 years is quite a short period of time, but Spain attracts a lot of British expatriates and a lot of British taxpayers. So there's your EU non-dom regimes, 5 out of 7. And then we get into the other regimes, and these are the most popular nations that British taxpayers are focusing on. Scandinavians too, French as well, because there's quite a few French nationals and French residents that are moving to alternative destinations because the choice is so wide these days. So you've got zero tax regimes, Bahamas, Bahrain, the Emirates. Don't be confused with corporation tax, 9% corporation tax in Dubai, 10 in Qatar, 15 in Oman, 20 in Saudi. That's the corporation tax regime, but a lot of these jurisdictions, Bahrain, Dubai, like Monaco, do not inflict any direct income tax. Then you've got low tax regimes of Gibraltar. That's a fixed rate of tax pursuant to the qualifying, non-qualifying category 2 rules. And you've got Hong Kong and Singapore, which are source-based tax systems, so highly beneficial, not a tax haven. Can also run your company from Singapore and Hong Kong, but they too will be subject to source-based tax systems, not taxation based on global income.
Their system is modelled on
Yeah.
our colonial tax system. They've retained that, and obviously they're very popular, and are seeing an influx of people move to them, basically by adopting the original model that the UK had. Singapore operates a remittance basis on foreign income,
Yeah.
but a lot of it is exempt.
A lot is exempt.
Don't have capital gains tax either. So attractive. But we're not seeing a load of people move from here to Singapore because it's obviously far away. It's the main reason. So I think where would you say the most popular?
For youngsters, Lawrence, it's a good question. For the younger fraternity, there's quite a few in the room today, and that's the Emirates. Corporation tax rate 9%, VAT rate 5%, but no direct taxation, and a high energy and high capacity of expatriates.
And just on the UAE and Dubai, and obviously not just Dubai, that's just one of the many.
Emirates. Yeah. 7 and 2.
7, there we are. But it is an important point that there's no income tax there, so you can take dividends from UK companies with no tax in the UK, no withholding tax, and then no tax in Dubai. You've got to make sure your total period of non-residence is typically 6 tax years, full tax
Statutory residence test.
The other interesting thing about Dubai is the tax treaty between the UAE and the UK. That does actually make pension planning very interesting there. Typically, for a lot of places, for example, Singapore, if you want to move to Singapore and withdraw your SIP UK pension, this is becoming very popular at the moment, this type of planning, with the pending inheritance tax changes with pensions. Everyone's looking at, well, how do I get the money out in the most efficient way? Well, if you move to, say, Singapore, the income has to be subject to tax, so you won't benefit from the treaty unless you remit it into Singapore. But with the UAE, they don't have that clause in the treaty. So it's quite interesting that you can move from the UK to Dubai and rely on the tax treaty, even though the benefits you take out are not subject to tax in the UAE. So that's, and you can still get a certificate of fiscal residence from the Dubai authorities in that situation. So that means if you have got clients in that position where they've got UK pensions, that's very much something to consider, is for them to relocate to Dubai get the PCLS and then flexi access, as long as you're non-resident for 6 tax years in total, then there shouldn't be any tax in the UK. You will need to make a claim for that.
Okay. And that treaty was signed between the UK and the UAE in 2017, so it's not exactly yesterday, was it? So good for business, mobility, corporate expansion mixed with the private client tax planning. There's quite compelling requirements, usually for a slightly younger person, Bahrain, Saudi, Dubai, but we've seen a lot of business head that way. So again, reading nation, tax regime, financial status, a useful reference document, and the requirements in how you really do it. And the last ones, again, Mauritius, a colourful island, plenty of residency regimes for financial independent persons, freelance persons, retirees, and again, it's a sort of a remittance-based system. Low tax, low cost of living. Monaco, yes, you don't pay tax, but your cost of living is a tax. But quite like going, but a little restricted in space. Andorra, Principality of Andorra, they came off the grey list of the EU and introduced taxation many years ago. It's where I started my career, actually, working for the only trust company in those days, decades ago. But they've introduced a 10% tax on capital gains and income. So as long as you are calculating a 10% liability, it's still not the end of the world, is it? So capital gains, income tax, 10%, and it's actually quite a nice place to be. Singapore, Lawrence's, he said domicile, then Lawrence's place of residence. And Switzerland is probably the last place where you can still enjoy a tax ruling valid for 10 years. So a slightly older client like myself that may be selling their business, maybe wanting to exit the UK, can decide to go on, apply for a lump sum tax ruling appropriate to their regime. It's not calculated on your wealth, income, and what you may make in the future. It's calculated by your household expenditure. I would like a particular house near a mountain so I can cycle up it and ski down it, but you've got a household that has an expenditure formula. You times that by a multiple, you times that by 30%, that's your tax ruling. It's not based on income, gains, wealth and all of that. It's based on expenditure, valid for 10 years, and that's living in Switzerland. You don't have to live there for 10 years. You can turn left or right and go to Greece, Italy, and anywhere else you might want to, but the capital gains tax planning in Switzerland is pretty compelling. So that's the residency grid, ladies and gentlemen. Trying to look for Roberta to make sure wine, soft drinks and beer is about to be served. We've got a couple of minutes for questions. Are there any questions, but we can take them during drinks as well? Any sort of quick questions to be announced? Anybody? Justin, you're very quiet. See, so far, sir.
I believe it's an engineering project. You were allergic to
Yes. Yes, it's not a disease that you'll find in the medical journal setting up a trust if you're allergic to a trust, but some clients have a reluctance of transferring wealth to a corporate trustee who may not have known them, or they have not known the trustee for some time, transferring wealth to a trust, and the trustees are holding that wealth for the benefit of beneficiaries. So they're giving up the wealth. They're not a director of our trust company, they've actually got to give it up, they've got to settle into a trust. And some clients are just a little bit, because of bad experiences of gifting wealth to others in the past. So the alternative to a trust might be a foundation, not for UK tax planning, or it might be a family investment company where they can still take back a bit of control on voting shareholder or being the director. Most people are not allergic to trust, but and in some cases you've got a private trust company, that's a non-regulated private trust company that sort of softens that bounce of giving away total control and influence. But there are some that just are not comfortable with setting up a trust because they've not grown up with it in their education, in their landscape, in their country of origins.
So it's much more personal.
It's a personal situation, but we do get those every now and again. But good question. Any questions?
But I can see this Dubai pension introduction becoming very popular.
Yeah.
Once the racial reads changes are more.
Well, just on that point with pensions that Justin's making, there's this proposal to remove the exemption for pension schemes from inheritance tax on 6th of April 2027. What the government is saying is that whatever's left in the pot with someone with a defined contribution scheme, such as a SIP, is going to suddenly now be subject to inheritance tax.
Yeah.
So if you've got, say, you die and you've got $500,000 in your pension, that's going to be subject to 14% tax if you narrate that and stuff.
So assuming the worst,
Yeah,
and it is as bad as everyone expects,
yeah.
what's the minimum you can spend in Dubai to cut your? Is it a year? Is that 2?
No, you'd have to.
Sorry, assuming
Yeah.
you can then
so-
move to Barbados or wherever you want.
Yeah, so the answer to that thing is that you've got to do 183 days in one Dubai tax year, which is a calendar year. That should be sufficient to get a certificate of fiscal residence. And then you'll be able to withdraw from your SIP. And then provided your total period of non-residence is 6 tax years, then you should be okay.
Anywhere.
Yeah, so that's the point. You don't have to stay in Dubai for the whole 6 years. You just have to be there when you extract from your SIP to claim the treaty relief. But I wouldn't want to be pushing it. I would say you probably want to do 2 or 3 years in Dubai and then go to Barbados or wherever for the rest of the
Travel from Dubai.
Well, no, the treaty between Malta and the UK for pension planning purposes does not work. The reason for, well, it does work if you're happy to pay tax on it in Malta, but the income tax rate is quite high. So Malta operates a remittance-based tax system for non-doms, just like our old system, which we've just abolished. But if you're a Malta resident with a UK SIP, you want to pull it out and rely on the tax treaty, there's a subject to tax clause essentially in that tax treaty. So if you don't remit it to Malta, you won't benefit from the tax treaty and you'll be taxed in the UK. The beauty about the Dubai tax treaty is it doesn't have a subject to tax clause. You've just got to be a tax resident for the purposes of the treaty.
If you were in Malta and on a global residency program, you
Yeah.
get 15% tax.
Yeah.
And you said your tax code into the 8.1C.
Yeah.
Would you then, when you take your drawings out, not for 45%?
Yeah, that's a good point. So if you were prepared to pay the 15% in Malta, that would work.
Yeah.
It should work. Yeah, because you are reasonable there, which is reasonable. It's still a big saving. I mean, it's a good point that you get that if you fall within that regime, it's a flat rate in Malta of 15%, isn't it?
Does that be the same in any territory that has taxation?
No, you've got to check each treaty on its own terms. Yeah, Cyprus is also quite useful. Yeah, and I think under the treaty between Cyprus and the UK, the taxing rights vest in the country of residence, which is Cyprus, and then you pull it out. There's no remittance system in Cyprus on foreign pension, it's just taxed at a flat rate of 5%, so that gets you there.
Yeah.
So that treaty is actually, and there's not actually a subject to tax clause in that treaty anyway. But the point is, if you move to Cyprus, you pull out from your SIP, you're looking at 5% there. So I think you're going to kind of get a league table soon with that. With pensions. Houghton.
John, can you ask to Lawrence a little bit?
Yeah.
Speak to Lawrence over a glass of wine. So there's information and notes on everything we've talked about tonight. The deck again is going to be distributed. Thanks to ICA, Irina and Belina, we're being videoed. Conscious we've been looking around a bit, Lawrence. Not like standing in the first slip. Dreadful day's cricket. England have suffered 500 runs in excess, and I'm not going to win this test match, are they? But we won the toss. It's dreadful. So everything we've got, there's information and notes on everything that we've announced and delivered tonight. What we also portrayed, we do in-house every day of the week. So nothing is outsourced with exception to
a bank account, a Commonwealth Garden bank account. That's probably one of the most difficult chores that we have in our existence, but we have special terms, and there's a few bankers and alternative banks in the room that look after our clients rather well. We also own 8 overseas non-UK trust companies, EU trust companies, mid-short trust companies, offshore trust companies, a wide choice because some of the practitioners do prefer a particular jurisdiction over others, and they simply won't deal with anyone or won't deal with us if we didn't provide a choice. 8 trust companies. We've got corporate services available in a dozen jurisdictions where we are licensed and regulated. We have 23 offices worldwide, 600 staff and management that represent our global group, and we're still under independent, in-house, old-fashioned ownership, not owned by a PLC or not a public company, not quoted and not private equity owned, which is quite rare in these days. So all of that, some of you have heard that all before, and others can read more about us if you want. And thank you for your undivided attention.